It's no secret that the pandemic brought a wave of new investors eager to give a shot at playing the market. In fact, according to a Charles Schwab study, 15% of all current American stock market investors got their start in 2020, giving rise to what Schwab refers to as the investor generation. Furthermore, with many brokerage firms now offering no minimum accounts and zero commission trading, almost anyone can begin investing, even with a small amount of money. To help guide this new generation of investors, as well as their more experienced counterparts, this video examined Warren Buffett's notable mistakes that every investor makes. We have all heard of Warren Buffett's successful investments in companies like Coca-Cola, Apple, American Express. In addition to being a brilliant investor, Buffett has graciously shared his learnings with millions of people worldwide. And one of his famous quotes is about learning from others' mistakes. Buffett says that while it's good to learn from your mistakes, it's better to learn from other people's mistakes. So, following his advice, I will examine Warren Buffett's suggestions of 10 big investing mistakes that every investor makes. Constantly watching the markets. This was the most common error noted amongst beginning investors. While keeping an eye on the overall economy is normal and generally advised, it's easy to get caught up in the excitement or doom and gloom of it all. The markets are constantly changing, and trying to keep up in real time can lead to you constantly checking or changing your investments when you'd be better off leaving them alone for the long time. When you are constantly monitoring the market, you are more likely to underperform than if you had simply stuck to your original strategy in the first place. When negative performance is viewed without context, it can lead to rash decisions, whereas positive performance can instill overconfidence. It is best for investors to avoid tracking their performance too frequently. While it's easier than ever to get instant information on your portfolio's progress, it doesn't mean it's necessary, says Buffett. Besides, it wouldn't make sense to track our mileage in quarter-mile increments if we were running a marathon. The same can be said for long-term investing, especially in retirement accounts, which typically have the longest time horizon. Before making an investment, ask yourself, can I hold these positions for a long time? Investing should not be boring either. So examine your investments on a quarterly basis, which should be sufficient for most investors. Guys, I'm Kevin. Do not forget to subscribe and like the video to be part of the 100,000 subscribers target. Let's proceed. Failing to understanding the investment. Warren Buffett, one of the world's most successful investors, advises against investing in companies whose business models you don't understand. To avoid this, build a diverse portfolio of exchange-traded funds or mutual funds. Before you invest in individual stocks, make sure you thoroughly understand each company that those stocks represent. Attempting to time the market. Attempting to time the market also reduces returns. Successfully timing the market is extremely difficult. Even institutional investors frequently fail to succeed in timing the market. The investment policy decision explains nearly 94% of the variation in returns over time on average. In layperson's terms, this means that most of a portfolio's return can be explained by the asset allocation decisions you make, not by timing or even security selection. Failing to diversify. Professional investors may be able to generate excess return over a benchmark by investing in a few concentrated positions, but average investors should avoid doing so. It is better to follow the diversification principle. When deciding on an exchange-traded fund ETF or mutual fund portfolio, it is critical to include exposure to all major sectors. In building an individual stock portfolio, include all major sectors. As a general rule, don't put all of your money into any single investment. Chasing the trends. Chasing trends is a common mistake made by investors, whether it's investing in the newest IPO or participating in the GameStop stock frenzy that we all witnessed in January. Most investors follow the next hot stock not knowing why they are choosing a particular investment other than the fact that someone else says it is awesome. A lot of investors make the mistake of chasing trends or what's cool because of fear of missing out. Buffett always advises doing your homework before putting your money in the market. Alternatively, for a more hands-off approach, invest in the markets passively through index funds and watch your portfolio grow over time. Using your brokerage account to purchase diversified mutual and index funds exposes you to less risk than purchasing a single company's stock. Letting your emotions rule. Perhaps the number one killer of investment return is emotion. Fear and greed do indeed dominate the market. Investing decisions should not be influenced by fear or greed. Instead, they should consider the big picture. Stock market returns can vary dramatically in a short period of time, but in the long run, historical returns tend to favor patient investors. In fact, as of May 13, 2022, the S&P 500 had returned 11.51% over a 10-year period. Meanwhile, the year-to-date return is negative 15%. An emotional investor may see this type of negative return and panic sell when they would have been better off holding the investment for the long term. In fact, patient investors may benefit from other investors' irrational decisions. Following bad social media advice, Buffett laments the amount of misinformation out there about investing and finances in general, particularly on social media. The overall advice from Buffett is straightforward. Take no investment advice from those who are unfamiliar with your personal financial situation. You might be better off putting that money into an employer-sponsored retirement account, particularly if your company matches contributions up to a certain percentage of your salary. When investing, do your own research and read up on the person providing financial advice on TikTok or another social media platform. Whether you're a novice or a seasoned investor, a free e-learning program for investors is a good place to start. Failing to giving your investments time to grow. When it comes to investing, time is of the essence. To maximize your returns, you should hold your investments for as long as possible. Investing is something you do with the expectation of reasonable returns over a long period of time, says Buffett. A big mistake out there is investors bailing out on an investment because they did not double their money in a certain period of time, which is usually days or weeks. If you need your money to grow urgently, you probably don't have proper savings. Quick growth is very risky and dangerous. Investing money that you will need soon. The most common mistake investors make is entering the markets without first establishing a solid financial foundation. You should feel in control of how you spend your money before investing. A big part of that is building a cash reserve so you don't need to rely on your investments when you run into an emergency or want to make a certain purchase. The stock market can be volatile, and you wouldn't want to lose money you were saving for something like a down payment on a house you wanted to buy. A good way to know if you're ready to invest is understanding if you have a healthy amount of cash in a savings account set aside for all your near-term goals. Money that needs to be spent in a short period of time, such as 1 year, should not be invested in stocks. Having unclear investing goals. Once you have a separate savings net set aside that you can fall back on, make sure you have clear goals as you go into investing. Otherwise, the goal of investing is rarely to make more money. Instead, people should see money as a tool for meeting their other goals. Making investing all about returns is a common investor's mistake. Buffett believes that if you can meet your goals with less risky investments, you don't need to chase high returns that also correlate with higher risk. While the S&P 500 is an easy proxy for how the market is doing, keep in mind that the design of your portfolio and performance should be aligned to meet your objectives, not an index that is unaware of your financial situation, objectives, or time horizon. How to avoid these mistakes. Develop a responsible action plan. Mistakes are part of the investing process. Knowing what they are, when you're committing them, and how to avoid them will help you succeed as an investor. To avoid committing the mistakes above, develop a thoughtful, systematic plan and stick with it. A responsible action plan refers to the act of determining whether or not you are responsible for your own action. If you do not feel qualified, seek the advice of a reputable financial planner or just invest in S&P 500 straight away. Remember why you're investing your money, and you'll be motivated to save more and may find it easier to determine the best allocation for your portfolio. Adjust your expectations based on historical market returns. You should not expect your portfolio to make you wealthy overnight. Wealth is built over time through a consistent, long-term investment strategy. With that said, don't forget to be in the first 100,000 subscription target by clicking the subscribe button and liking the video. Also give me a comment. Click the video on the screen.